Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Jamie.
And I'm Alex. You know, looking at the stack of stories this week, I feel like I'm getting some serious regulatory whiplash.
That's a lot, isn't it?
It really is.
Yeah.
Usually it's a steady stream of capital requirements, a few basis points here and there. But this week, it just feels like we're living in two completely different timelines at the same time.
That's a perfect way to put it. It is a week of just massive contradictions.
Right.
On one hand, you've got people telling us to prepare for this AI future, a country of geniuses in our data centers, and that's supposedly coming next year.
Science fiction stuff.
Complete science fiction. And then on the other hand, the industry is, well, tripping over hurdles that feel positively Victorian.
Victorian is the word.
We're literally talking about spelling mistakes causing huge regulatory problems, and a £40 million bill for, of all things, postage stamps.
It is the ultimate high-tech, low-tech clash. So, what is the mission for this deep dive? How are we going to get our heads around this?
Well, we've got a packed agenda. First, we're unpacking a £160,000 sanction fine.
Caused by a typo.
Caused by a single typo, and why that just changes the liability game for every single compliance officer listening.
Okay.
Then we're looking at that massive bill for recorded delivery that the banks are fighting. And then we have to go macro.
The bigger picture.
The collapse of trust in the U.S. dollar is literally pushing Germany to recall its gold. And closer to home, a seismic shift in domestic politics. Reform UK is polling at 31%.
31%. That is a number that, wow, that definitely demands a closer look.
Hmm.
Today is Friday, January 30, 2026, and if there's a theme for this week, I think it has to be the fragile geometry of trust.
I like that.
Whether that's trust in your automated software, trust in the U.S. Fed, or, as we'll see later, even trust in your own HR department. So let's dive in.
Let's do it.
Okay, we have to start with the typo. Bank of Scotland, part of Lloyds, just got hit with a fine from OSI.
That's the Office of Financial Sanctions Implementation.
£160,000. Now, let me just play devil's advocate for a second. To someone listening who's running a big compliance book at a tier 1 bank, 160 grand, that might sound, well, manageable.
Almost rounding error.
Real.
Exactly. But don't let that price tag fool you. The actual amount is small, but the precedent here is massive. This is a red alert for anyone relying on automated screening.
So what's the reality here? What happened?
Okay, so between February 8th and 24th, 2023, the bank processed 24 payments.
24.
And they totaled about £77,000, all for a customer named Dmitry Evzianikov.
Right, and just to refresh everyone's memory, because I doubt we're all tracking Crimean regional politics, who is this guy?
Well, he's a designated person, a big one. He was the Russian-appointed governor of Sevastopol, and he was actually criminally convicted right here in the UK, sentenced to 40 months for sanctions breaches and money laundering. So he isn't some complex shell company 5 layers deep. He is a very known entity.
So how does a known entity with a criminal record just walk through the digital front door? Was it a fake ID or something?
No, and that's the absolute nightmare scenario for ops teams. He opened the account through Halifax, and he used a legitimate UK passport.
A real passport.
The whole problem was that the name on the passport had a spelling variation compared to how it appeared on the sanctions list.
A spelling variation. So we're talking about a transliteration issue, converting from Russian Cyrillic into English characters.
That's it, exactly. Like using an I instead of a Y, that sort of thing. And this is where it gets really sticky for the banks.
Go on.
They had an automated screening tool. It uses fuzzy matching, which is designed specifically to catch these kinds of variations. That's literally why you buy the software.
And it didn't flag it.
It didn't flag it. It wasn't some complex cyber evasion. It was just letters.
But hold on. If they had the tool in place and the tool failed, surely that counts for something. Reasonable due diligence. You bought the system, you implemented it, so why the fine?
And that is the critical takeaway. OSI is taking a strict liability stance. They explicitly said that transliteration issues are foreseeable risks.
Foreseeable.
They're saying you cannot just buy a tool, set it to standard, and then forget about it. If your tool fails on a risk they deem foreseeable, then you have failed. My software didn't catch it as well. It's just no longer a valid defense.
That is a harsh standard. It sounds like the compliance officer is now personally guaranteeing the algorithm of the software vendor.
It does, and it actually gets worse. Later on, The bank's systems did identify PP alerts and adverse media for him.
So they did catch him eventually.
They did, but, and this is the crucial operational gap, they didn't restrict the account fast enough. So even when the alarm bells finally started ringing, the doors didn't lock immediately.
That's the hygiene failure you mentioned. It's not just the tech, it's the process around it.
Precisely.
And this just feels like the perfect setup for our next topic. We are literally talking about a bank failing to catch a name variation basic literacy. Meanwhile, the tech world is telling us that by next year, 2027, we're going to be dealing with intelligence that makes us look like toddlers.
It is such a jarring pivot, isn't it? From this legacy failure to absolute future shock. This comes from a new essay by Dario Amodea. He's the CEO of Anthropic.
I saw this, The Adolescence of Technology. It reads less like a road trip and more like a warning from a time traveler.
It really does.
He uses this phrase, country of geniuses. It's a great headline, but let's just unpack it. What are we actually talking about here in terms of capability?
We're talking about AI models that are, and this is his claim, smarter than Nobel Prize winners.
Smarter in what?
Across biology, coding, maths, engineering, you name it. But the kicker isn't just the raw intelligence, it's the speed. He predicts that by 2027, which, let's remember, is next year, these models will be operating at 10 to 100 times human speed.
So it's like hiring a million Einsteins who can work 100 times faster than a person, never sleep, and never ask for a bonus.
And who can use a mouse and keyboard? That's the big agentic shift he talks about. These aren't just chatbots answering questions. They're agents.
What do you mean by agent?
They can navigate the internet, use software, open applications. They can execute tasks that would normally take a human weeks to complete.
That sounds incredibly disruptive for the labor market. If an AI can do a week's worth of analyst work in an hour, what on earth happens to the analyst?
He doesn't sugarcoat it at all. He predicts the potential displacement of 50% of entry-level white-collar jobs.
50%.
Within 1 to 5 years. For banking, that's your back office, your junior analysts, your KYC processors. It is a massive economic shock just waiting in the wings.
And yet, in the middle of this existential warning, our own government is jumping right into bed with them.
We are. The Department for Science, Innovation, and Technology, DSIT, is partnering with Anthropic to bring their Claude AI assistant to gov.uk services.
I see the contradiction we mentioned right at the start. So we're integrating genius AI into government to help people renew a passport, but banks are struggling to patch a spelling mistake on a sanctions list.
It just highlights that fragile geometry we talked about. We're rushing towards this alpha AI future, but our basic compliance infrastructure, the hygiene, is still failing on, well, literacy tests.
It just raises a huge question, doesn't it? If we can't trust the systems to handle a simple typo, are we really ready for the country of geniuses?
I don't think we are.
Speaking of systems struggling with the basics, let's talk about stamps, because this next story, it just represents the absolute friction of bureaucracy. A £40 million bill for postage.
Yeah, this is the motor finance redress scheme. We've talked about the commission scandal, but now we're in the weeds of actually fixing it.
Logistics.
And the banks are warning that the draft rules might mean they have to use recorded delivery to notify 14 million customers about their rights.
14 million letters by recorded delivery. That is a lot of paper.
It is. And the industry estimates that the postage alone, just the stamps and the tracking, will cost an extra £40 million.
Wow.
And the picker. This specific line item was apparently just missing from the FCA's original cost estimates.
That's what I call Victorian friction. We have AI that can rewrite code bases in seconds, but we're arguing about the price of sticky labels. But this does tie into a broader theme with the FCA at the moment, doesn't it? They're getting much more aggressive on transparency.
They absolutely are. This is the enforcement watch policy. The FCA has adopted this new posture where they are willing to name and shame firms under investigation much, much earlier than they used to.
Right, and we saw a live example of that, didn't we, with a firm called the Claims Protection Agency, TCPA.
Exactly. The FCA announced they were investigating TCPA. TCPA obviously didn't like that one bit, so they sued to stop the FCA from naming them.
And they lost.
They lost. The High Court ruled the FCA can name firms in exceptional circumstances if it's to protect consumers.
So the regulator has a judicial green light now. If you're under investigation, you can't count on that privacy anymore.
No. And for any banking professional listening, that completely changes the risk calculus. Reputational damage is not something that happens after an enforcement notice now. It can happen the moment the investigation goes public.
Okay, let's zoom out. We've gone from typos to stamps. Now let's talk about gold bars. Because there's a huge story brewing in Germany that sounds like the plot of a thriller, but it speaks directly to that theme of trust.
This is where we get right back to that fragile geometry. Germany is experiencing what economists are calling access anxiety.
Access anxiety.
They have 1,236 tons of gold stored at the New York Federal Reserve. That's worth about 164 billion euros.
That is a serious chunk of the National Reserve. Why do they want it back all of a sudden? But the Fed has stored gold for nations for decades.
Two words: the Trump factor. There are these growing fears in Berlin, and this is not just fringe stuff anymore, that a future Trump administration is just too unpredictable. There's a genuine fear of asset weaponization.
You mean like what happened with Russia's reserves? When the U.S. froze them?
Exactly. That precedent just spooked everybody. The question is, if the U.S. wanted to pressure Europe on trade or on defense spending, could they just freeze access to that gold?
And this isn't just one political party anymore.
No, it used to be a talking point for the far-right AfD, but now the Green Party in Germany is demanding the gold be repatriated. They want to ensure strategic independence.
That is the signal, isn't it? When the Greens and the hard right agree on something, you know the center ground has fundamentally shifted.
And this anxiety is driving the price through the roof.
Yeah.
Gold has hit over $5,100. And it isn't just central banks. Look at Tether, the stablecoin issuer. They're reportedly buying $1 billion of gold every single month and storing it in a Swiss bunker.
A Swiss bunker. It honestly sounds like a Bond movie. But speaking of political realignments, we have to look at what's happening right here in the UK. Because the political risk isn't just in Washington anymore. The latest polls for Reform UK are, well, they're explosive.
It's a potential extinction event for the traditional Conservative Party. The latest polling has Reform UK at 31%.
And the Conservatives.
Trailing at 21%.
And Suella Braverman has now defected?
She has. She's joined Reform, which gives them 8 sitting MPs now. It feels like a cascade. You're hearing former senior Tories basically say the old party is dead.
And why does this matter for the banker sitting at their desk in Canary Wharf?
Because it just signals a period of intense domestic policy instability. A party polling at 31% isn't just a protest vote anymore.
No.
That's a potential government in waiting. We're not just watching a government change. We could be watching a complete realignment of the entire opposition.
And amidst all this domestic chaos, the Prime Minister is in China.
Yes, Keir Starmer's trip. And the details from that trip are so telling about the level of trust between the two countries. The whole delegation had to use burner phones because of espionage fears.
The burner phone protocol, nothing says diplomatic trust, like leaving your iPhone at home because you think your host is listening in.
Exactly.
Yeah.
I mean, he secured visa-free travel and some cuts to whiskey tariffs, which is good for trade. But he's taking heavy fire back home over human rights, especially regarding Jimmy Lai. It's a real tightrope walk.
Just a quick pause here. If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
It really does.
Okay, let's pivot to the consumer side. The FCA has just released a new market study on what they're calling the protection gap. This is study MS241.4. What's the headline here?
So this study looks at pure protection products. We're talking life insurance, critical illness cover, income protection.
Basics.
The basics. And the headline stat is pretty stark. 58% of UK adults have no cover at all.
Wow. 58% seems dangerously high. Is that a cost of living issue? Are premiums just too expensive for people?
That is the surprising part. It seems it's not about price. Of those who don't have cover, 59% have never even considered it.
So it's not that they've looked and decided against it, they just aren't looking in the first place.
Exactly. It's an awareness gap.
So is the FCA going to crack down on commission? I know that's been the fear ever since the retail distribution review. The regulator usually hates commission.
Surprisingly, no. Unlike the RDR, they are not banning commission. They found that for people who are in the market, competition is working pretty well. Claims acceptance is high, around 98%.
So the problem is just getting people into the market.
It's purely access and awareness. They want to nudge people rather than ban the entire sales model.
So they're looking at things like targeted support.
Exactly. And behavioral nudges to get people covered. There's a small focus on what they call churn intermediaries, moving people just to get a new commission, but that only affects about 0.1% of policyholders.
So the main regulatory push is going to be about awareness.
It seems so. How do we get people to realize they need this without regulating the sector to death? That seems to be the question.
Which brings us right back to that lack of awareness. Okay, it's time for the quick hits. We call this tailwinds and turbulence. I'll throw a story at you. You tell me why it matters. Ready?
Ready?
First up, the Reeves U-turn. Chancellor Rachel Reeves announced a 15% business rates discount for pubs.
That's a classic tactical retreat. It came after the Revel Collective collapsed and about 1,000 pubs actually banned Labour MPs from their premises. It shows fiscal discipline hitting the hard reality of the high street. The government blinked.
Next, Emil the Seal.
Yes. Yes, Emil the Seal. The FCA installed a statue of a seal at Waterloo Station.
A seal? Are you joking?
It's a visual metaphor. Seal the deal. Get it. It's to warn the 700,000 people who are victims of fraud each year. It's a bit of fun, but the numbers behind it are deadly serious.
Okay. Guava Pay collapse.
This is a critical one for anyone in payments. It's an EMI, an electronic money institution, that failed. And it highlights the safeguarding gap.
Right, so listeners need to remember, these funds aren't FSCS protected.
Exactly. That means if the firm goes bust, the government doesn't write you a check. Customers have to rely on the liquidator to unwind the safeguarding pod. It's messy, it's slow, and it damages trust in fintech.
Citi lawsuit. This one is getting a lot of traction in the city.
Julia Carrion is suing Citi. She's alleging weaponized HR, claiming the HR department actively protected the wealth boss, Andy Sieg, after she made sexual harassment complaints. It puts non-financial misconduct right back at the top of the risk register.
Trading 212.
They were caught selling crypto ETNs exchange-traded notes to retail clients. The problem was, they didn't have the dealing and debentures permission. A reminder, you can't just bolt on crypto products without checking your license covers the instrument.
And LIBOR returns. I honestly thought we were done with LIBOR.
We're never done with LIBOR. The CCRC has referred 5 former Barclays traders back to the Court of Appeal. The scandal is not over. It's the zombie of financial regulation.
Cash access.
The Dorothy House Hospice in Wiltshire says they pay £42,000 a year just to bank their cash donations. Charity shops are now urging people to pay digitally just to save funds for patient care.
That's a fascinating flip of the usual narrative. Cash is now the expensive option.
It really is.
And finally, a really grim reminder from Asia.
Myanmar and China. China executed 11 members of the Ming Mafia. They were running industrial-scale scam centers. It's just a brutal reminder that behind the fraud stats on our screens, there's often a very violent physical reality.
A heavy note to end the quick hits on, but an important one. So if we look at the whole board, what does this all mean? We've covered a lot of ground.
Well, if we connect it all up, it's about this really messy transition we're in. On one side, you've got Dario Amodei promising us AI with Nobel Prize intellect.
The country of geniuses.
That can work 100 times faster than us. And yet on the other side, we are drowning in £40 million worth of postage stamps and still struggling to spell check a sanctions list.
It's that gap, isn't it? The gap between the alpha ambition and the hygiene reality.
It is. And for our listeners, I think the takeaway is that you just can't focus on the shiny future. The risks, whether it's a typo, a postage bill, or a geopolitical shift, they're often hiding in the boring legacy details.
And here's a final thought for you to mull over. We talked about AI displacing jobs and the government using it. If AI really does become this country of geniuses, will we eventually need a sanctions list for AI agents themselves? If an autonomous AI breaks a law or facilitates a sanctioned transaction because it found a loophole, who do you sanction? The developer, the user, or the code itself?
That is a question I don't think OFSI has an answer for you.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.